to our floor show, and we are joined by John Sylvia, president of Dynamic Economic Strategy and former Wells Fargo economist, and New York Stock Exchange trader Tom Hayes. John, I'll start with you. What do you make of these three warning lights, separate and then put together?
Well, I think you put them together, and they are a warning light. Simply, I understand the Fed's pursuit of very low interest rates to help stimulate the economy. Although in my world, the problem with the economy is simply uncertain aggregate demand in the economy. But with low interest rates, basically, again, for equities, it's a low discount for future earnings. So you can understand why stock prices are up. Also, with the low interest rate, the opportunity cost of holding gold or silver is also incredibly low. So you can understand why those prices are up as well. So these are all interrelated, driven by those low Treasury rates, which at this point in time, quite frankly, Liz, I don't see rates as the problem for the U.S. economy. I think it's uncertain demand.
John, let me just push you, though, because right now we've seen the 10-year tick slightly higher. If we can get that up on the screen at 0.61%. And you're looking at this at the moment. When you see that, plus the gold picture, 1,944 was the earlier high there. So we're starting to see some strange things happening just as the stock market continues to rise. What trigger will you be looking for?
Well, the challenge, I think, Liz, is the 10-year, but also the credit spreads. What I would be looking at, the high yield spread, the AA corporate spread for high grade, both are below the levels of February. So I'm thinking, okay, now why is that possible? I think with the Fed buying corporate bonds, it really has pushed those quality spreads lower. So I would look at it. I would look at the following: look at the real economy, jobless claims. Look at the financial markets, both the 10-year and credit spreads.
What about you? What are you looking at, Tom? As a trader, you are way more on I'm not saying tick by tick, but certainly week by week, maybe 24 hours a day. You're looking at these moves. When you step back, are you seeing anything that worries you at all?
Not so much worry, Liz. I think, number one, obviously we have to get the extension of the enhanced unemployment. We now know that the bid from the Republicans is an extra $200 a week. The ask from the Democrats is the status quo, an extra $600 per week. That needs to go into place right away because those expired this weekend. And I think we'll get that carve out hopefully by the end of the week. The second thing I think we're going to see this week, Liz, is in the FOMC statement, more rhetoric about yield curve control, which will be a very positive thing because unlike 1947, they're focused on the short end of the curve up to the 5-year Treasury, which means they'll let the long end go out. That's yield curve steepening, which will incentivize banks to lend to small businesses, to do mortgages, to lend to consumers. That's great for the recovery. You've got to have that credit extension. And then, of course, tech earnings and the tech hearings. So the hearings are on Wednesday. The earnings are on Thursday. These stocks are priced for perfection. They've got to meet that high bar, or we're going to see more of a rotation into cyclicals as we saw last week and as we saw in the month of May when the recovery looked quick. So those are the key focus things that I'm paying attention to right now, Liz.
John, when you look at the overall picture and you see everything, we're also waiting on a stimulus plan that will be hopefully greenlit for all the 35 million people, 32 million people who are unemployed right now. Are you worried that if we don't see a plan, that this could somehow trigger some type of disruption or dislocation in the markets?
I would say yes, for two reasons. One is simply consumer sentiment. Without another package, you do have 30 million plus people whose attitudes towards their jobs and their economic future has just deteriorated. Second, picking up on the prior program with Charles Payne, a lot of these are service workers, and the sense that these people just don't have the deep pockets to sustain consumer spending going forward. So yes, I would take it as very much a fiscal cliff, if you want, and very much a negative for the economy and for a lot of consumer discretionary stocks.
Great to see both of you guys. And I don't know if we can at least look at this, but we did get, Tom, a nice number for durable goods for the month of June, and that was a big surprise to the upside here. So when you look at names like Caterpillar, some of the heavy equipment companies, even with an overhang of what's going on with the tensions between the U.S. and China, which we're going to talk about coming up, doesn't that still bode rather well for those companies?
No question about it, Liz. And you see the economic surprise index the last couple of weeks at record highs. The economic data continues to beat. We'll see it also for Q2 GDP on Thursday. Will definitely beat. It'll be a bad number, but that's in the rearview mirror. So moving forward, I think we're going to see this progression of economic beats and recovery and getting closer and closer to a vaccine. And that's what this stimulus package is all about, a few-month bridge until we get a vaccine at the end of the year and get back to normal.
Well, it is the Manhattan Project right now, or Operation Warp Speed, which is exactly what the president is going to at least look at, one of these 200 companies that are trying desperately around the world to find a vaccine. Great to see you both. John, Sylvia, welcome.
Thank you.
And we appreciate Tom, as always.